Hey all, welcome to ShareTreck. It is the 3rd of April 2022, and I hope you're having a great weekend. And today's topic is Are recession fears justified? And we're going to take a deep dive into the consumer and what they're experiencing in the US. And from that, we'll try to draw some conclusions. Let's get started. There's a lot of talk of inverted yield curves and impending recession. Some commentators point out that the market falls around 14 months after yield curve flattens. And there are also some theories about how the market falls when the yield curve inverts and starts moving upward. So all those kind of theories are out there, and there's a lot of historical facts that you can find. But I think that the current situation is very unique in the sense that we have a pandemic and we have a war. And the only similarity with the previous recent recession is the oil prices being high. Earlier, it was an artificial one due to an embargo, and now it is due to war. So we can't reliably believe what happened in the past is likely to happen in the future. Or that what happened in the past will happen in the same intensity in the future. It could be worse or it could be better. We don't know about that. Meanwhile, during the last week, Kathy Woods also released a new video talking about disruptive innovation, and I will talk about that next week. I just wanted to percolate through my system so that all my logic circuits can go through it and I can form my own conclusions on that. But it's really good for ARK Invest to make the research secular and available to everybody. That way we have good quality research and thought process in our domain. It definitely helps. So I draw a lot on Kathy Wood's videos. She has some really good point. And also, like a mechanic, what we need to do is when there's a problem, we need to open the hood of the car and look into the engine and start diagnosing the situation and trace it point by point. And we'll be able to come to a conclusion and diagnose the situation. I approach most of my investment decisions from Maslow's theory. So Maslow has this triangle hierarchy of needs. So at the very bottom of the triangle are the primary needs, which is basically food, clothing, and shelter. Now, in the modern context, we can add medicine, which is very important, like healthcare. Another set of indispensable modern necessity is education. Everybody needs an education, and everybody needs transportation. Because in most of the US metros, everything is around cars. So transportation is a big issue. And that brings the impact of gasoline or oil prices into the public domain in a very, very direct manner. So we're going to look at all these dimensions of the economy in order to decide whether we should really be worried about recession. And the reason I'm talking about this is because this morning when I got up, as usual, I went into YouTube and there was this clip of Jim Cramer saying that the market is being very pessimistic and professionals usually look forward and not in the rearview mirror. And things should be much better going forward. It's all looking great and it should be much better. But what I am thinking is that, of course, Jim Cramer is the opinion mobilizer. So he has got a big platform and people are going to listen to him and he can move markets to a certain extent. But as retail investors, we got to be absolutely alert, just like a deer in the forest. At the slightest moment, we should be able to detect danger from a long distance. So it's not what the market should do that we have to be worried about. It's what the market is actually doing that we should be worried about. So that's my 2 cents about it. So with that, let's first start by looking at the housing market, right? So I have taken these stats from BLS.government, Bureau of Labor and Statistics. So if you look at this chart out here, you got the 2018, 2019, and the latest percent changes out here between 2019 and 2020. So if you look at housing overall, there's been a 3.5% increase from 2019 to 2020. We still don't have statistics for 2021, and we are running the first quarter of 2022 behind us. So The owned accommodations, the prices have gone up by 9.9%, and rented it's gone down by minus 0.5. So that's the numbers that we have here. But these are a rear view and not even close rear view. This is a much distant rear view. But if you look at 2021, what we had seen in 2021 was government had come up with a lot of measures in order to protect the ordinary worker and the common man, the middle class basically, and put in two sets of measures. One set of measure for preventing foreclosures, another set of measure for preventing evictions from rentals, and also a freeze on rent. All these measures were in place, and they kind of disguised the weakness in the housing market. Now those forbearance measures are being rolled back, and it's going to have a big impact on people who are renting, as well as people who are landlords who are stretched thin, and also people who are owner residents of their house, whose mortgages are going to go up, whereas the home price is likely to go down. So we had this COVID-19 related migration from high-cost metros like New York and from major cities in California into low-cost jurisdictions like Florida and probably in Arizona and certain other parts of the country, where they could get a bigger house with a yard at a much, much less price. So some of the people, they bought additional properties as second homes, and many left the city and went away because the city attractions were down. The lockdown meant that people had to work from home, and typically the city condos were all much cramped, with children also not being in school. It became very difficult. So those who had second homes, for them, they're not likely to sell the house. They may probably use it as a vacation property. But the ones who actually moved from the city into the low-cost jurisdictions might probably have to go back to the city when companies start insisting that employees come back to work. So that movement is starting. We don't know which way it's going to go. If companies start requiring a good portion of their employees to come back to work, the metros are going to be hot again. And anecdotally, as I mentioned to you in the previous video, Toronto is already seeing people coming back into the metros because of the major attractions like entertainment, sports, everything happening, restaurants, nightlife. All of that is drawing people back in, and the rents are also going up. They're gone above the pre-pandemic levels. The cost of condos are also rising very sharply, whereas I'm predicting that the suburb home prices are likely to moderate. So that's the situation that we are looking at. And when it comes to US in particular, mortgage rates have been at around 4.5%, and they're only likely to go up as the Fed increases the interest rate by 50 basis point, as it has alluded, and as the market has factored it in. Jim Cramer was talking about the fact that the Fed will have to go light and they have to be less hawkish. I agree that that's what the Fed may have to do in order to prevent us getting into a stagflation or a recession environment. But the Fed cannot be seen to be doing a flip-flop. So any of those moderation measures, that the messaging will have to turn around slowly like a ship. So that's the point that I'm thinking is going to cause a little bit of volatility in the market while we wait for Fed to do the messaging. So if we come down to specifics, the average rate on the 30-year fixed mortgage raised 24 basis points to 4.95%, much quicker than expected. As both mortgage rates and home prices went considerably higher, the median mortgage payment went at least 20% higher than it was a year ago. This has weighed on demand for mortgages and refinancing loans. And that means that less and less people are going to be getting mortgages and refinancing. They're going to stay put with their lower interest rates because if they go for refinancing, the rates are going to be higher. So that also means that there are many people who are not going to move out of their current house, which is going to reduce homes coming to the market for sale to a certain extent. But that is for people who are solvent and who can still maintain their mortgage and who are on fixed rates. Lots of people who are on variable rates and who are not as solvent would be having problems, and they may bring their properties to market. Pending home sales show number of signed contracts on existing homes fell 4.1% in February as compared to January. So there is a drop in the sales that is happening. And this is the fourth straight month of declines in pending sales, which are an indicator of future closings 1 to 2 months out. So whenever somebody buys a home, they are signing a contract to buy, let us say in January, but the actual closing and changing of ownership is going to happen 2 to 3 months down the line. That's when the money is taken by the seller and the keys are handed over to the buyer. That is called closing. The monthly median mortgage payment on new mortgages is now taking up a much larger share of a typical consumer's wallet. It jumped 8.3% in February as compared to January. And I suspect with the 7.5% inflation coming in, other components also would have increased, as we'll see as we go further in this presentation. That's what I have in the tables that are in front of you. They have all been taken from Bureau of Labor Statistics, and it's a very reliable record. If there are any revisions, we'll come to know about it. But these are reliable records on which we can base our conclusion. If we go further and look at food expenses, which is the other indispensable thing that everybody wants to be with, you can see that in this particular table, which I've again taken from US Department of Labor, Bureau of Labor Statistics, you can see that the price changes in annual average food at home prices were 3.5% higher in 2021 than in 2020. So we have a more current information out here. So that's much better for us. We don't have to guess. And also for context, the 20-year historical level of retail food price inflation is 2% per year. So we are already 1.5% higher. That's significant. So from 2% a year, we have added 1.5% on top. So it's almost a 75% increase in the inflation. So when we go to look at the inflation charts, you will see how high the inflation has been in the first quarter. So we'll talk about that in a subsequent chart. Now let's take a look at student loans. Student loans, we can't say it's absolutely a flat amount for everybody. Now this data I have got from here, I've also put the link below, educationdata.org. So this talks about average student loan. And if you look at the legend here, it talks about low-end education, high-end education, and mean monthly payment. So that's the color coding. So let us go with the low end or an average, a blend of all of these. And then if we look at the monthly cost for education for a given student, it comes to roughly around $393 per month. And the average student loan debt, which I've taken from other sources, is $39,351. And the number of students who owe more than $100,000 per head stands at 2.6 million. These are all not records from the first quarter of 2021, but statistics from not the first quarter of 2022, but statistics from 2021. If we look at the overall collective student loan debt, it is $1.75 trillion, and number of student loan borrowers is 43.2 million. So these are significant numbers, and these are also consumers in the market. So people who have student loans and who are supposed to pay have finished their education and are now working. So this is going to take a good chunk of money from their monthly paycheck, apart from housing that we saw earlier and the food costs that we saw earlier. As you can see, the disposable income is becoming smaller and smaller. All those discretionary expenses like taking a vacation or buying a fancy jewelry or something like that, all those things have to take backstage. Wedding costs and other things will have to be moderated. So that's where the whole thing is going. Now, if we were to look at healthcare expenses, so this statistics is coming from Health System Tracker website, and in the United States, you have $11,945 per capita as the healthcare expenses. This is statistics for 2020, and we still don't have information for 2021, and we are in the first quarter of 2022. So you can imagine a number is not going to go less than 11,945, but it will only go more, especially because of the impact of the pandemic. But another way of looking at it could also be that due to pandemic, there were lockdowns and hospital capacities were filled up, and ICUs were handling more of COVID patients. Therefore, all those patients who had chronic illness like heart disease or diabetes or anything else that caused mortality, which used to take a lot of hospital expenses, probably did not take place, and they tempered down the costs. But as the ICU capacity start opening up, all those costs will start coming in. And even if the patients did not go for critical surgeries, they were still having medicine costs and nursing costs, which would definitely have continued. So 2021 is likely to have looked worse than what it looked in 2020, where we are at the early stages of the pandemic. So if we were to look at the median income of an American, the real median earnings for all workers aged 15 and over with earnings decreased from 1.2% between 2019 and 2020. So that is from 42,065 to 41,535. So there has been a decrease. So when we talk about real median earnings, real income means the purchasing power. So the actual income you might see has gone up. Especially we have a lot of news reports saying that in 2021 the labor market was tough and the hourly rates went up. So those are actual dollars that you count, but the real income is what is it that the dollar can purchase. And given the inflations that has been taking place, the real income has gone down. And that's the point that I'm trying to make in this particular slide. Even though we don't have data for 2021, we know that in the last 3 months there has been a lot of inflation. We'll talk about that. I have a separate slide showing the quantum of inflation that has happened. The total number of those who worked full-time year-round declined 13.7 million between 2019 and 2020. So 2021 has not been that better either. The latter half of 2021 started seeing a little bit of reduction in lockdowns, and especially the hospitality sector got a few more rounds of employment taking place. But I think 2021 was not that much better than 2020. The number of female full-time year-round workers decreased by about 6.2 million, while the decrease for their male counterparts was approximately 7.5 million. This is the impact on full-time workers. And also there has been a trend, not only in US, but also in Canada, a trend of people moving from full-time employment to precarious employment. I'll explain what I mean by full-time employment and precarious employment. I would consider full-time employment to be a situation where you're working with a company and you're working 9 to 5, and you're getting all the benefits, including medical benefits, and you have workplace safety and other guidelines being followed, and you have vacation pays and stuff like that. And precarious employment is when you become an independent contractor and you're invoicing the company, and you do not get any medical benefits. You're not covered under any of the legislation. You have to take care of that by yourself. That is what I would call precarious employment, because you can be terminated at will, and you get a lump sum of money which is much bigger than what you would get as a salaried person, but you have to take care of all your expenses, and your taxation is much higher. Therefore, you kind of incorporate and put money into it and just withdraw dividends or smaller salary. So that also damps down your ability to spend, and your wallet is much smaller, and your current expenditures are kind of constrained. I'm seeing the trend more and more to people getting into more of precarious employment, and employers have less and less responsibility when it comes to employees. 2021 statistics I don't think are as good. They are not yet available, but we'll have to see the COVID impact, where more people are working from home. And especially hospitality industry workers, they were having a tough time because hotels were closed, entertainment centers were closed, theaters were closed. So all those people who are working backstage as studio hands or usherers in theaters, waiters in restaurants, cooks in restaurants, cooks were still having a lot of work to do because takeaways were happening. But most of the people who work in contact positions, customer contact position in retail, they all had to sit at home without income. And that's where the COVID subsidies from the government came in handy and was part of the problem of creating the inflation. But it was the right thing to do in my books. Now, let us look at gasoline. because US is more automobile dependent rather than public transport dependent. Lowest income households had an average burden of 18.3% of their wallet being taken by gasoline costs. So when you look at gasoline prices, it doesn't hit everybody equally. Somebody who's got a household income of 500,000 is not going to be hit as hard by gasoline price increase as a percentage of their expenditure as compared to someone who's got an average household income of $20,000 or $18,000 per annum. For them, the gas price hike is the biggest hit because they need to travel to work. Traveling is indispensable. They can't walk all their way to work. And we have had stories before pandemic. These are all huge stories where somebody saw a young man walking 30 to 40 kilometers daily to go to work, and he didn't have a car. So people crowdsourced and bought him a car. Those kind of stories were there, if you recollect, in 2019 and 2018. They were heartwarming stories. But that underscores the importance of public transport. So public transport is not very strong in most places. Therefore, people have to rely on cars. And cars come with a lot of expenses. One of the major expenses is gasoline. And the second expense when people rely on second-hand cars is repairs. And parts have been short to come because of supply chain shortage. So parts are expensive, repairs are expensive. That all factors into taking a bigger chunk of a consumer's wallet when it comes to transportation. Low-income households had an average burden of 13.8%, while higher-income households had an average burden of 4.1%. So you can see that the lower-income people had the biggest hit onto their wallets. And if you look at the inflation trends, I have this comprehensive chart here. This is coming from rateinflation.com. You can see in January and February, we had an inflation of 7.4% and 7.8% respectively. And in the last few months of last quarter of last year, 2021, you had October at 6.22%, November is 6.8%, and December is 7.03%. This is how fast the dollar has depreciated its purchasing power. So you can imagine the impact that this has had on people and their ability to purchase. This is what the Fed is looking at, and this is why the Fed wants to bring the prices down. And the only thing they can do is dampen the demand. What the government can do, on the other hand, is grease all the gears and make sure that the supply side is meeting the demand. And that way, the Fed and the government can work together to bring down the demand and the supply and reduce the cost price. But the major worry for the Fed is that while they increase the interest rates, it's going to make the dollar much stronger. And therefore, our exports are going to become more expensive. And when exports become expensive, exports will drop, and that will reduce the sales of export-oriented industries. And that could lead to unemployment, shutting down of plants, and that can feed into recession. So that's the fear that the Fed has got. So it is going to calibrate its approach. And that's where Jim Cramer is saying that the Fed will also have to take cognizance of the fact that the inflation is going to cause the markets to lose employment if interest rates are pushed up much more aggressively. So all in all, we don't know how these things are going to pan out, but it's good to get a first-hand feel. So each of you are living your own life in the States, and you know how it feels to your wallet. Look at all the things that I have explained and think about your own behavior and multiply that by many times. And that's what I think the market is going to do. And that will be reflected in the demand for products of various companies. And the companies which have got greater pricing power, like companies like Apple, or companies which are selling necessities like food products, like salt, sugar, those kind of companies, meat, those kind of companies will be able to increase the price and maintain their margins. But the other companies where it is discretionary expenditure, they are going to feel the hit much more drastically from a drop in consumer spending. So you can make your own opinion on that and look at all those companies which do not have a control over their prices. And that's where you look at the economical theory of elasticity of demand. And luxury goods and necessities have a lower elasticity of demand, and they are much more inelastic, and they do not respond too much to change in prices. Like if the price went down, somebody is not going to eat too much of salt. And if the price went high, somebody is not going to consume less of salt. They need the same amount of salt. So that's how I explain the inelasticity of demand. Companies which are producing inelastic goods are going to do reasonably well, and that's where the money is going to go and rest. So housing stocks and stocks which are doing consumer staples, they are going to be doing much better than other stocks like travel and leisure and those kind of stocks. So that's my thoughts about it. And if you look at the Fed's approach, they have been saying that they'll do a 25 basis point hike in March, and which they did. And the revised estimates call for 50 basis point hike in May and going forward. And revised estimate call for original 25 basis point to be blown up to 50 basis point. And the markets have kind of factored that in. And the year may end well with around 3% interest rate hikes. The need to tame inflation may potentially end up killing jobs. Now, this is where I would come to talk about my own conclusions. That is, regardless of the promise of CRISPR, conditions are going to be tough. So we may believe 100% in CRISPR, and I believe in CRISPR 100%, but the conditions are going to be tough. The young workforce will be the hardest hit under the crushing student debts, and also the older workforce, which is retiring, it's going to go out under a cloud because all their retirement investment and everything is suffering in their 401k portfolios, because there is this risk factor against them, and things can go south anytime. So that's a problem for them. Older families will be hit hard with medical care, and increased interest rates on loans, including student loans. So the older gentlemen who are likely to retire are more likely to postpone their retirement because of the uncertainty, and they would definitely have chronic conditions for which they have medicines, and they depend on medical insurance from their employer. So they will extend their working life, and increase interest rates on potential student loans and mortgages, student loans for their children which are going to college, and mortgages are going to be increasing. So that puts them in a very tough spot. Potential housing crash looms in US markets, and greater mortgage payments and falling housing prices could lead to negative equity and foreclosure, along with a flood of new homes into the market. This is the worst case scenario. And if you guys are interested, I am personally a broker, and I follow the housing market closely, both in US and in Canada. So if you are interested, put your comments in the bottom, and I'll come up with a separate video just on housing, and that can be a conversation for a different day. But right now, there is definitely a risk of housing sector being weak, and as a result, there being some foreclosure. And those things also indicate that the ability of the consumer to borrow from their home equity line of credit and keep the market supported is kind of falling. At the most, people may like to consolidate their credit card debt and put it into their mortgage. But borrowing from a home equity line of credit to use it for vacations and buying cars and all those things, they are going to diminish significantly. And I think for genomic ventures, it's going to be the private equity firms which are going to be able to corner the opportunity in genomics. And we as retail investors are likely to come for second dibs at a later date when market conditions improve and our own wallets become stronger. Our own personal finances are on much more stronger grounds. At that point of time, the private equity guys will take their profits and give us equity shares, and we might probably end up buying it at a premium, but it will still be worth it. But that's where I think overall everything is going to go, because the share prices of genomic companies are going to depend on the ability of the retail shareholder to hold on to their stakes, and their ability not to be afraid of losing their capital. So that's where I think a good portion of the market behavior will end up. And as mentioned before, for genomics, more mergers and acquisition will take place in this sector, and potential takeovers of genomic companies by big pharma is likely to be there. So banks which are more into mergers and acquisition, they will do much better this year than other banks. And recent comments from a White House spokesman indicate that the port bottlenecks have been resolved, and this can ease inflation if it is true. And if the port congestion is lower, then imports can flow much faster. And with a stronger US dollar, imports will be cheaper and it will be better. But the trade war, which was started by the previous administration with China, has got to soften up so that things become much easier. And also, Chinese government stand on the companies listed in the US, as well as the US rules for Chinese companies listed in US stock exchange. All those things need to resolve positively for the entire stock market to stabilize with regard to the Chinese sector. And 1 million barrels a day from strategic reserve does not make much of a dent in the overall demand. It's a step in the right direction in terms of sending the message from the government that they are working on the supply side to tame down the oil prices. And it was a political necessity, but it's not making much of a dent considering the volume or magnitude of consumption of oil in US. The Iran deal or resolving of Ukraine crisis can help reduce the oil prices. OPEC could also lend a helping hand. And that's where what I think is that weakness in China is something that we have to be concerned about. The government is trying to support all business sectors, including real estate in China. And meanwhile, the wealthy Chinese are moving their family offices to Singapore amid the Chinese government's push for income equality. They want equality of income, which they are calling prosperity or common prosperity. That's the term that they are using. And that is driving a lot of family offices, Chinese family offices, to move to Singapore. So wealthy Chinese families have this concept of family offices, which handle all their investments, businesses, and trusts and everything. So those are moving off to Singapore. And that definitely is going to cause a little bit of problem for the Chinese government and the Chinese economy. On the other hand, US has a labor shortage and inflation, as we saw. It's tracking about 7% consistently for the last 3 months. War in Ukraine has raised the oil prices, and Europe, especially Germany, the growth engine of Europe, is taking a big hit due to Russian gas issue. And also, Ukraine is called the breadbasket of Europe. And Russia supplies a lot of metals that are used in industry. And all those things are causing food inflation. I fear that food inflation is going to be a very, very big problem, along with the problem of people fleeing war zones in the Middle East, and now people fleeing war zones in Ukraine, and all those moving populations which do not have a job, but which will come into a host country. And the host population is already under a lot of inflation. And the government's ability to tax the people is also going to be much more constrained with raising interest rates. So it's going to be a really big political problem for governments, and also an economic problem in terms of supplying the essentials, food, clothing, and shelter for all these populations which are going to come into much more stable economies, and thereby importing inflation and instability into stable economies. And that's a major concern for me. So overall, I doubt how strong April will be despite historic trends, but I am still sticking with my thesis of selling by third week of April and sitting on the sidelines. So again, even though Jim Cramer, a very influential voice, is saying look ahead rather than looking in the rear view. That's a very good sentiment, but I'm afraid that the market probably doesn't have the stomach to handle all this volatility that's happening and all these difficult trends that are underpinning the economy for the common man who is supporting the entire economy. So that's where I think I would like to say that I do feel a little concerned about recession. I do feel concerned about employment levels remaining where they are. So I'm going to be very cautious in April, and I'm going to look for the slightest of rumbles that I can hear, and probably take profits wherever I can, while trying to optimize my position on the big ones like Tesla, which is again a disruptive, innovative technology, because as oil prices go further higher, people are going to realize electric vehicles are worth it. And they are going to move to electric vehicles, and the electric vehicle market is going to increase in size. The pie is going to increase, more players will come in the place, but Tesla will still be a lead, and the market is going to grow bigger. Tesla will sell more vehicles. So I'm not going to sell too much of my Tesla stake. Amazon is also going to do very well. and it's going to be selling a lot of consumer staples, and that's going to continue. And Amazon, the entertainment section is also going to be there. The cloud section is also going to be there, which is going to give a lot of revenue. So that story is still intact. Apple has the capability to handle the prices, and it's a strong company. So I'm not going to do too much of selling on Apple. Google, again, is a company which is going to be resilient to all these trends because people are still going to surf the web. Advertisements are going to be served, and also its cloud revenue is going to stay in place. Its AI business is also going to do pretty good going forward. So overall, I'm still bullish on Google. The places where I'm worried about are the ones where I have got companies which are not very strong, like Shopify, for example, is a company that I would be concerned about. And there are a few other holdings I have, apart from the real estate investment trust, which are good in good times, but which are not doing well right now, and which are likely to be hit by this discretionary expenditure compression that's impending. So that's what I would like to say. You can all look at your own portfolio in light of what I have discussed and make your own conclusion. Once again, this is not financial advice. This is my personal opinion. So do your own due diligence, and that's about what I have for you. I hope you're having a great weekend. If you like this video, please put a like there. Just take a moment to do that. That gives me a message that you like the content, and also helps YouTube to place this for others to see, bring more people to our channel. And if you're not yet subscribed, why not? Just subscribe and become a member of our community. You just have to press a button there, put the subscribe there, and you'll see all the new contents I have for you. And that's going to be great contents going forward. And thanks, and have a great day. Bye for now.